Welcome back to the slightly windblown edition of the Money and Wealth Show. I'm Sterling Fox. We are down in the heart of the business district in Vancouver. Our special guest this week, precious metals analyst David Morgan. David, you were talking before the break about a lot of the work you've done in your professional career involving teaching investment skills and an investment philosophy. And I'd really like to pursue that a little bit on today's program, if you don't mind. A lot of people have, frankly, stopped playing the game. It's just got too blinking weird. They've just taken their money and they're on the sidelines and I'm out. What do you say to people like that? Because we all know in order to survive and retire with some measure of comfort, there's got to be income. And a lot of that should come from investments. So what do you tell people who are skittish?
Well, I think you have to have conviction, and obviously you need to know what you're doing. Now, any investor that's invested for very long knows that you make mistakes. And one of the toughest things for beginning investors is to admit when you're wrong. So one way to make it almost mechanical is to have a stop-loss philosophy. And that would be getting into a stock or a company that you're interested in. You've done your research, you've done everything you possibly can, and you decide this company is worth this amount.
Okay.
It's selling for less than that amount, therefore it's a buy. You buy it. Something happens. It goes lower. Well, most people think you should average down. Averaging down works occasionally, but generally speaking, it'll kill you. So the market, again, usually knows more than the investor knows. We don't know why it's going down, but you should actually have some kind of a loss limit that's set.
So before you even buy, you've got to have in your mind, okay, I'm going to set this line as the bottom, and if this stock heads south on me, I'm going to bail when it hits that mark, and then I've taken a minimal loss compared to being completely wiped out.
That's right. There's been a lot of fortunes made that have been given back. There's been, I'll call good investors that have made a lot, and they didn't really learn the rules of investing and ended up giving a lot of it back. It's sort of like going to a casino, and I'm not saying investing is a casino game.
Some do.
But what I am saying is that a lot of, you go way up and then they don't know when to leave the table.
Sure.
Or once they've made a lot, how do you preserve it? In other words, let's say, moving on the same topic, that you made a lot of money speculating in the junior mining sector, for example. Now that you've made that money, it'd probably be better to move into very conservative mining equities rather than juniors to preserve it, because those are lighted matches. I mean, those things will burn you if you hold them too long, for the most part. Certainly there's some that continue on, become mines and all that, but the odds are against that. So it's a philosophical shift in that specific case. The point being that you've really got to obey rule one. And Warren Buffett has rule number one. Rule number one of investing is don't lose money.
Okay.
It's that simple. So if you obey rule one and you do your homework and you invest, now there's a difference between investing and speculating, and I do both and I teach both. The problem is...
But the speculating is the casino stuff compared to a more conservative investing approach.
Absolutely, Sterling. And what I'd like to say, continuing on that, and you're right, is that a lot of investors are failed speculators. And here's what I mean. They go into a junior mining company, for example, and it starts going south, even though they read, myself or somebody else that said this is a good stock, and so they bought it. Or they did their own research, they bought it, and it goes down. They don't have a stop loss in place, but they love this story, right? So they ride it all the way down. Well, they bought it with the intention that it was going to double within 6 months, and once it doubled, they would sell half, which is what I call a free ride, and that's what I teach, especially on the junior side. And then they hold the rest basically for free, and if it goes up, it goes up, and if it goes down, well, they really haven't lost
So
much.
if I can interrupt there, what you do is you invest a certain amount of money, and once you've achieved that amount, you take your original money out.
Absolutely.
And then let it ride, let the rest ride, right?
Exactly, and it's a very simple concept. I want to get back, I'm going to digress a bit to like the overall philosophy. If you keep it simple and sincere, you're going to do a lot better than getting into, what the Black-Scholes method of options expiration is to make sure I'm getting the last penny out of my options writing. I'm getting way off topic in a way. It's still investing. The point I'm making is you've got to keep it basic, simple, and understandable in the beginning. If you do that, you'll have a foundation, and then you could go on to these other more exotic ways to invest. But it's common sense, but when it comes to money, people seem to lose all common sense.
Well, it's our money, damn it. We're emotional about it. We worked hard to earn that, and we're more than a little touchy about it, and thus we tend to make mistakes like hanging on to what seems like a good thing for too long.
That's exactly right. So the failed speculator becomes an investor, and the psychology goes, well, this company's still a good company. Maybe I'll buy more on the way down, and I wasn't really going to sell it after 6 months. I'll hold it for as long as it takes.
Sure.
And a lot of these people have these portfolios of mining companies in my specialty that they should have gotten rid of a long time ago. And, you know, quite, in all honesty, I used to give these smaller companies a little bit more of a chance than I should. I still make that mistake myself from time to time, but we do use a stop loss in almost all cases. So, you know, I try to, you know, live what I teach, but, you know, you can't be perfect 100% of the time. I'm not, but I certainly have a good track record on how to invest. And I like to put serious money into serious companies. I think that's another rule that you should really obey.
Very quickly, and we're almost out of time, but this is important, and I'd like to hear your answer. How important is it for an individual, unsophisticated investor to get the services of a professional financial advisor or other person like that in the industry to get him or her through all of this?
I think it's the second most important thing.
What's the
most? I think the most important thing is to get an absolute solid education. Now, if you can't take the time to educate yourself, then step 2 comes in. Get somebody you know and trust and read their work and use it to your advantage.
Lots more from David Morgan available on the web anytime you want to go to themorganreport.com. David is a prolific writer, and it's an excellent website. Mr. Morgan, thank you, sir. Good of you to join us again on your visit to the west coast of Canada. Always appreciate it.
Always a pleasure. Thank you, Sterling.
We'll be right back.
Good afternoon. My name is Larry Ray. I'm the chairman and CEO of Molycorp Gold Corp. As the name states, we do have a deposit we're developing in British Columbia, which is a pure molybdenum deposit. But our focus these days is on magnesium in Nevada. Through serendipity, we discovered a large deposit of magnesium running about 10% with a high purity and consists of about 256 million tonnes at this time, 52 billion pounds. Our main emphasis is to move this project forward by beginning a drill program later this year in which we can increase the integrity of the resources into the indicated and inferred, as well as increase the resource itself. For further information, please visit our website at molycorp.com or phone us at 604-531-9639.
Tax Tips with David Ingram.
Did you buy a new home, a new condo, or even a sailboat that you live on in 2009, or at least since January 27th? Federal government came up with a $5,000 new home credit if you or your spouse have not owned a house in the 4 preceding years before you made your new purchase. That's $5,000 of cash. Just got to fill out a form. It's a good one. That's a tax tip from David Ingram.
And that's our program for this week. Our thanks to David Ingram and to our special guest, David Morgan. And thank you for joining us. If you have some thoughts about today's show that you'd like to share with us, please send them along to comments@themoneyandwealthshow.com. I'm Sterling Fox. See you next time.
Comments made on the preceding paid commercial program are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time.